Good morning. We're up to Chapter 4 on our assignments, and Chapter 4 assignment is problems 1, 2, got 5, 7, 12, and 22. 1, 2, 5, 7, 12, and 22, and let's take a look at those. Okay. And actually, I didn't set these up the way I'd like you guys to present them, so I'd prefer that you have a separate tab actually for each problem. It's a little bit easier to correct, so shame on me. I think I can make that maybe even bigger though and let you guys see it. So I did problems that were similar. I kind of made up numbers here to have you guys take a look at it. But Chapter 4 deal a little bit with some financial forecasting and looking at some stuff here. End of the year, how much cash are we going to have is our first problem, and that has to do with Eli Lilly. They do a good job of picking some names, don't they? But anyhow, Eli Lilly is very excited because sales for his nursery and plant company are expected to double. That would be great, wouldn't it? From $600,000 to $1.2 million next year. Eli notes that net assets, liabilities will remain at 50% of sales. So think about that. If your assets were at 50% of sales and your sales were $600,000, your assets were at $300,000, right? However, if they go up to $1.2 million and your assets are still 50% of sales, your assets have to increase by $300,000 then to $600,000, right? And we'll look at that in my example. His firm will enjoy an 8% return on total sales. So ROS, he will start the year with $120,000 in the bank and bragging about the Jaguar and luxury townhouse he's going to buy. Does his optimistic outlook for his cash position appear to be correct? Compute his likely cash balance or deficit at the end of the year. Start with beginning cash and subtract the asset buildup equal to 50% of the sales increase. And then add back in profit. So here we go, and I've used some different numbers, but same as, it's the same problem, just different numbers that you guys have. I said that my beginning cash was $200,000 and that my sales increase is $1 million. Okay? And so I'm going from 1 million to 2 million. Okay? And like your problem, my asset build is going to be $500,000. And what's important about that is that that's going to be a cash drain, right? That's obviously going to take away from my cash if I have to put $500,000 into building my plant or whatever, equipment, etc. So, okay, so I start with $200,000 in cash, and my sales increase is 1 million. I'm sorry. My asset build then is 500,000 or 50% of the increase in sales. Okay, and I put that in as a negative because that's a negative cash. My new sales for this coming year, my projected sales are 2 million, and I put that my return on sales is 9%. Okay? So I take 9% of my sales for my projections, and I get that, right? This is equal to my 9% times my 2 million, or 180. And that's a positive contribution to cash, and my beginning cash is positive. I started with $200,000, but my asset build is a minus $500,000. So in the end, in my problem, yours may end up different, but in my problem, I end up having a negative $120,000 in cash. Okay. Is that the whole story? Well, that's the whole story cash-wise, but, honestly, if the projections held true, would this business have any difficulties financing some of that? No, heck no. If you were doubling your sales like that and you had a 9% ROS, you wouldn't have any difficulties financing that type of a build-up in your assets. To finance 300 grand of that or 400 even grand of that would not be out of the question. And it's, if you did that, obviously you could counteract the loss of cash that you would have. So that would be the most normal scenario. Okay, problem 2. Philip Morris. Oh, we go from drugs to tobacco. Philip Morris expects the sales for his clothing company to be $550,000 next year. Philip notes that the net assets, asset minus liabilities, will remain unchanged. So a little different here, right? His clothing firm will enjoy a 12% return on total sales, and he will start the year with $150,000 in the bank. What will Philip's ending cash balance be? So again, I did something similar, and I just said I'm going to have $200,000, and I'm going to add to my cash position. This one's actually easier than number one, right? But I'm going to add to my cash position based on the profit that I make, and I'm using it 8%. I think your guys is 12%, and you need to enter that as a 0.08, or in your guys' case 0.12, right? We have to enter our percentages as point whatever, and so my sales are $200,000 again. So I take my return on sales times my sales, and that's going to give me my profit. And that's also going to be what my increase in cash is. My beginning cash was $20,000 in my example. Of course, your guys' is different. Your guys' is $150,000, and then simply I just have to add these two to get what my ending cash will be. So a little different story. I'm going to be improving cash in that case. Okay, moving on. You guys have 7, so I think I did 6. Gets to be a little bit longer. Let's take a look at 6. Cybersecurity Systems had sales of 3,500 units at $75 per unit last year. The marketing manager projects a 30% increase in unit volume sales this year, so that 3,500 units is going to increase by 30%. With a 40% price increase. So boy, not only am I generating more units, I get to up my price too. That's pretty impressive. That doesn't happen all that often. Returned merchandise will represent 8% of total sales. What is your net dollar sales projection for this year? And I think your guys' is similar. So let's just take a look at last year's. Last year I had 3,500 units at $75. So, you know, last year's revenue then was equal to my price per unit times my number of units, or 262,500, right? Okay. And then I just put my information down. My sales increases 30%. My price increases 40%. Okay. And I came up with this, but let's, first I wanted to see what my unit increase was. And there's a couple ways you could go about getting to this number, and so this one I just put off to the side, and I simply said if I'm going to have an increase in sales of 30%, okay, this is equal to that 30% times my last year's sales. That's my increase. Okay, that's how many units more I'm going to sell this next year. Okay, so when I get down here to current sales per units, and I'm going to show you a couple different ways to approach this. Okay, obviously if this is my increase and this was my last year's, I could simply say that this is equal to this, this plus this, right? 4,550 units. Okay, a shortcut. Okay, and I tend to use the shortcut is anytime you have a sales increase of 30% like that, if you break it down, use your algebra, it says that the new sales would be equal to last year's sales times 1 plus the percent increase. All right, if you put that into a formula, which means that it would be equal to last year's sales times parentheses 1, because basically that's just giving us last year's sales plus the percent increase, right, which is 30% or 0.30. Okay, and I get the same number when I do that. Okay, and again, to even abbreviate that more, you could simply say that this is equal to my last year's sales times 1.3. That gives you the same thing. Okay, now I got to figure out my price, because my price went up by 40%. And the math is the same. Okay, if my price went up 40%, I can do that over here. This is equal to 40% times my $75. So my price went up 30 bucks. I can add that and get the 105, or I can use the other formulas just like I did up above. Okay, so my new revenue then is simply going to be my price per unit times my number of units. So this is simply equal to my 105 per unit times my current sales. So nearly $500,000 in sales. That's a nice little bump up, wow, in revenue. And my return, according to my problem, is 8%. Yep. Oh, that's what my returned merchandise is. I'm sorry. Okay, so I'm gonna have returned merchandise that I'm gonna have to give them credit for, okay, or give them their cash back, give them their money back, and I need to calculate what that amount's going to be, and that's going to be a negative, right? Okay, and that'll detract then from my dollars, okay, and so I just put in it's an 8%, and I need to calculate what that amount is, and so it's simply equal to my 8% times my revenue prediction up here. Oops, you know what I did wrong though? Because look at that, that gives me a bigger number, and I know that that's not the case. I need that to be smaller. Okay, so this should be equal to, but I can just use my minus key. Let's try that. I can say minus my 8% times that, and that'll give me a negative number there. Okay, and then I got to make sure that when I do this, I hit my equal, and it's this, and since this one's a negative number, I go ahead and hit my plus sign, because plus a negative is the same as subtracting a positive. Ooh, yeah, it is. There you go. Okay, and your guys' problem number 7 is similar. So jumping over, and you guys have 12, and so I did 11. We do some last in, first out, first in, first out. Okay. I kind of go, and they don't have this as an accounting term, but for me, like, well, when I went to college, anyhow, it was as the bar. That's kind of where I learned accounting terms, but it was a little different. I was first in, last out, and I don't know that they have that in accounting. Anyhow, okay. On December 31st of last year, Wolfson Corporation had in inventory 450 units of its product, which cost $22 per unit to produce. During January, the company produced 850 units at a cost of $25 per unit. Assuming that Wolfson Corporation sold 800 units in January, what was the cost of goods sold assuming FIFO, or first in, first out? Okay. Pay really close attention when you guys do your number 12. Your guys is LIFO, meaning last in, first out. Okay, so your formula is going to be a little different, or you're going to have to take a look at that, but the math and everything else will be pretty much the same. So here we go. I said that my year-end inventory, I just wrote down again the information that they gave me. So 450 units, my cost to make those was 22 bucks. And so my total cost of goods for the stuff that I had last year was 9,900. Okay. In January, I made 850 units at 25, and I made that much. Okay. Although that doesn't really come into play. What I need to know is that I sold 800 units. Okay, and I didn't really do that math any place here, but I did 800 units, and I'm going to sell first in, first out. So I'm going to sell these 450 units first, and so I might need to, come over here and say, well, let's do it down here. This is equal to, well, let's just do it right here. Okay, this one, my 350 that I have there, but it's actually equal to the 800 units that I need minus what I had at the end of the year, right? So I'm going to make 350 units, or I'm going to use 350 of these 500 because I'm first in, first out. Remember, you guys are last in, first out, okay? Meaning that I'd have to use up, if I was doing last in, first out, and I've sold 800, I wouldn't even sell all of January, so I'd sell all 800 at 25,000. Okay, but I got my 450 that I made there, and I've already done that math, and it's the same math, right? Okay, so I just said it's equal to that. Now then, I'm going to sell 350 of them, and they're going to be at this $25 price point, right? Or cost, $25 cost. So I simply have to put this is equal to my 350 times my 25 bucks per unit, and that's equal to that. So my total cost of goods sold is equal to $18,650. Okay, so we've done 1, 2, 5, 7, and we did 11, we did 6, and so we're down to the last one, which is 22. And 22, you need to set up a good spreadsheet, and you need to be thorough on this one in order for it to, I think, work properly. Let's take a look at it. And I think yeah, your guys's was 22, so I think I did. Yep, I did the same problem. Hopefully, I just changed my numbers a little bit. So it says write lighting fixtures, forecast its sales in units for the next 4 months as follows. So again, okay, and I got different months. I got September, October, November, December. It doesn't really matter. And my unit sales, okay, I have at 10,000, 15,000, 25,000, and 20,000. So I'm gonna change this because I should put in there that this is unit sales. Okay. And my cash sales and rate maintains an ending inventory for each month. Let's talk about your guys' problem. In the amount of 1.5 times the expected sales in the following month. Okay, so what we're saying is that we need to have in inventory, if my expected sales here are 10,000, what I'd want to have is 1.5 times that, or 15,000 units in inventory ahead of time. Okay, and we'll talk about that as we come down here to these last couple of columns, I believe. So, okay, the ending inventory for February, March's beginning inventory, reflects this policy. Okay. Materials cost $7 per unit and are paid for in the month after production. Labor cost is $3 per unit and is paid for in the month incurred. Fixed overhead is $10,000 per month, and dividends of $14,000 are to be paid in May. 8,000 units were produced in February. Okay. Complete a production schedule and a summary of cash payments for March, April, and May. Remember that production in any one month is equal to sales plus desired ending inventory minus beginning inventory. Ooh, holy cow. Okay, I gotta look. Am I doing the right question here? Because this looks a little bit different. I got cash receipts versus credit receipts, and you guys don't really have cash receipts versus credit receipts. So I think I've got the wrong example here. Let me see if I've got another example down here. No, that's different. I'm going to pause for a bit because I don't think I have the right example on there. Okay, shame on me. I did number 23, so that other one that I had on there was just the wrong one. I don't know if that's from an old book or something, but I did number 23, which is very, very similar, so sorry, but we can read through it, but it's basically the same. I got the Volt Battery Company has forecast its sales in units as follows, and its ending inventory is 110% of the next month's expected sales. The ending inventory for December, January's beginning inventory is 1,460 units, which is consistent with this policy. And then it has my material costs, etc., much like yours. So let me enlarge this. Okay. So I input, the data again up here, my January unit, input variables, etc., etc. Okay. And it says my December production units were 1,100. Let's see. Okay. I was trying to see where I got the 1,100 from. Let me pause for a second and make sure I got that correct. I got that. Oops. Oh, sorry. I thought I'd hit the pause, but apparently you guys got a lot of blank from me. Anyhow, the December production unit was given to me, so sorry I had to look that up. Okay. So then I came down and I entered in, right, my projected unit sales, which are just given to me up here. January, February, March, April, May, June, July. Okay. And you guys have a little shorter time frame. My desired ending inventory, remember, is 110% of my projected sales for the next, right? So I can simply do this, okay? It'd be 10% times this plus this, if that makes sense. Or, as I said earlier, I can simply say that this is equal to this one times 1.1, or 110%. Okay. Uh-oh. That wasn't right, because it says it was 1,460, didn't it? So that was entered in there. Yeah, they must have got me goofed up there. Let's see if this one's right. Yeah, 1.1 times, and so this is equal to this one times 1.1. Okay, sorry, that one's off, and I don't know why. It was given to me, the 1,460 was given to me as my inventory. It's a little bit off. It's 30 units off. Okay, this one then is equal to my next month's sales times 1.1, or 110%. Okay, now that, just so you know, you can grab this, okay, and you can drag that, and that's going to copy that same formula. And you'll see my numbers didn't change because they were in there, but that's taking 110% of this number. This one is 110% of this number. This one is 110% of this number, etc. Okay? So my total units required, what's that mean? Well, okay, this is what I'm projecting to sell, and this is what I need at the end of the month, right? Because I want that much inventory going into the next month. So my total units required are just this plus this, right? So again, I can hit this plus this. Okay. And then I can simply take that, and again, I can drag that down there, and the formula is going to stay the same. It's going to add the 2 above it. Okay. Then I subtract from that what I had for beginning inventory, right? Because then I need to know how many I need to produce each month. Okay, so this one's simply equal to, oh, wait. It's just equal to minus what my prior month's inventory was. Okay, so it gives me a negative numbers along here. And again, I can simply take this and, okay, and it'll reference, this one references there, this one references there, and I put a minus in, so it turned it into a negative. And I could put that in parentheses instead of having the negative sign if I wanted to. Okay, so then my units to be produced is simply this minus this. Since this is listed as a negative, though, remember I have to say that this is equal to this plus this. Okay. So I should be able to look at it and know that that should be a positive, about 1,100 units or thereabouts, right? And again, I can copy that down. Okay? And that's just stuff entered there again. Okay? So now, once I know what my units produced are, and December was given to me, January, February, March, I get all from up here, right? This is just simply equal to this number. And I can copy that down, and it just picks up all those numbers there. Okay, now I just take and I calculate what my material and labor and my overhead costs are, okay, for each of those. So my material costs, I've got the amount up here, material cost per unit, but it's paid 1 month after production. Okay, it's paid 1 month after production. So I get 30 days basically to pay my material costs. So my material costs are equal to $14 per unit times what I had to produce in the prior month. So this is simply equal to my $14 times, get my asterisk there, my prior month's production. Okay. Now I got to show you a trick, because if I move this now, my numbers are going to get really weird, and I'll show you. Okay, why is that? Well, because when I copy something, it keeps the reference the same. So it's always going to be looking to this number, but it also would be looking, as I went down along here, for a different number in each one of these columns. Okay, I can fix that. Let's come back to here, and my reference up there, oops, let me go up, is C13, and I want that to not move. I want that to stay the same. Let's put a $ in front of both the C and in front of the 13. So I've got $C, $13, and I'm going to hit enter. Okay, and that's going to put that there. Now watch, okay, when I drag that, okay, what it's going to do for this one is it's going to come up and it's going to say then C13 times this month's production. Okay, and we'll see if that works. Hopefully it does. Boom, we'll go there, and voila, it worked. Okay, another way to do that is if you were actually, if you clicked on this, and I'll just go back and I'll delete that. Okay, so if I went that this is equal to my material cost per unit. Now hit your F4 right afterwards, and you can see that puts the $ in there then. And then I can hit my asterisk for times and my prior month's production, and there we go. Okay, my labor cost, on the other hand, is equal to my units produced this month times $7. Okay, and again, I want that $7 to stay in place, so I'm going to just hit my equal sign. I'm going to hit that, and then I'll hit my F4 key. That puts the $ in there, times my units produced this month. Boom. And I can just copy that down there, and that'll, take $7 times each of these. Okay. The $8,500 per month is my overhead costs that were just given to me. It said that's my overhead cost per month is $8,500. So I can put that in as $8,500, and again I can drag that down. Oops. There you go. Okay. Interest, it says I'm only going to pay interest for mine for number 23 in March, right? Interest of $8,500 is scheduled to be paid in March, and then an employee bonus of $13,700 paid in June. Okay. So $8,500 in March, I just enter that in as an interest, and then I got an employee bonus in June of $13,700. So these are all the things that I have to pay out. Okay, so these are just my accounts payable basically. And so now I have a total, and I don't want to include in my total, do not emphasize, do not include those units produced. I just want my dollar payouts, right? These are all based on the units produced either this month or last. Okay, and I'm going to hit delete, and we'll just do that. Okay, and now I can do, the easy way is to do auto sum. Okay, so if you come up here to the right hand corner and you hit this auto sum, and I hit the down arrow, it gives me these. I can get a sum, average, some other deals there which are kind of cool, but in this case I just want a sum. And look at that, it actually identifies then the numbers that I need. And I want to include these even though there's nothing there that month, because they'll be down here. I got them entered as zeros, and so that's fine, but down here then I'll have some, and that way I can simply grab this, drag it down, and there I go. Okay, and that's what I have paid out. So it's really not difficult to put this together. It's just kind of time consuming and a little painstaking. Take your time and put it together correctly. I didn't go over 4.4 or 4.5. You guys have 4.5, I believe. And 4.5, I got to go back. I'm sorry. I'll do it real quick. Talks about Bronco truck parts expected to sell, Bronco Truck Parts expects to sell the following number of units at the prices indicated under 3 different scenarios in the economy. The probability of each outcome is indicated. What is the expected value of the total sales projection? So what we're doing here is we're applying, and I want to see, make sure I got something a little different. I do. Okay, we're applying, I've taken number 4, and we're applying probabilities to projections. Excuse me a second. Sorry, I had to sneeze. And then coming up with a final number. Okay, and this is really fairly easy. It outlines it for you. It tells you how to set it up. So you got outcome, probability, units, price. Set all those up. Okay, then take your price times the number of units that you're going to sell, and that's what this is. Okay, so we could call this, actually we could call this sales. Okay, and what that's saying is that if I were to sell 225 units at $20, this is what my sales would be. So I just put this as equal to my $20 price times my 225, and I can hit enter. Now, like we did horizontally last time, we can do that vertically. This time I can grab that, just get that little, the black cross there instead of the white one there. Get the black cross in that corner, left click and drag it down. Okay, and then I kind of want to underline that too. Then I apply the probability. Okay, so I've calculated if I sold the units for this price. Okay, then I just calculate the probability of each of those, meaning I take this times my 70%. I take this one times my 10%. And again, that's simply equal to my probability times my estimated sales. Hit enter, and I can drag that down and underline that. Now I just take these. Remember, I got 100% here, so I'm saying that there's a 70% chance I'll have this outcome, a 10% chance I'd have this outcome, and a 20% chance I'd have this outcome. Okay, and if I want to do those, I'm really kind of taking in a weighted average is what that would be. We don't call it that here, but that's basically what it would be. I can take a sum. It identifies those, hit enter, and that gives me the right number there. Okay, so oops, bottom double border, there we go. That way it looks a little cooler, and I should highlight that. Okay, that goes through all those problems for number 4. Sorry, I had to hesitate a little bit in there and I had the wrong one. I need to go and get rid of that one, and I probably shall, so before I save this completely. I'll be giving you chapter 5 here soon, and one other video yet today. Thanks.